Hello, good day. I hope you are doing well. So today we are going to continue with the computation of additional information and also preparation of financial statement for a partnership firm. And the question that we are going to deal with will be given to you. You will see it on the screen now. So this is the question. The following list of balances as at 30th September 2021 has been extracted from the books of Firdaus and Salamat, who are trading in partnership. Okay, so two people, they are trading in partnership. These are the balances that they've given us. Freehold property at a cost of 30,000, which was acquired on 30th September 2020. Provision for depreciation 30th September 2020 was 6,000. This is the accumulated depreciation for freehold property. We have fixtures and fittings at a cost of 18,000 with a provision for depreciation of 9,600. This is the accumulated depreciation for fixtures and fittings. We have inventory at 30th September 2020, supposed to be 2021. Yeah, 2021, 30th September 2021. That will be the closing inventory. We have account receivables. We have account payable. Account receivables the same as debtors. Account payables the same as creditors. We have balance at bank, and we have gross profit. We have establishment and administrative expenses. We have sales and distribution. Capital accounts at the 30th September 2020. Firdaus, Salamat, we have current account. With respect to the current account, Firdaus is having a credit balance. That means her current account is having a positive balance, but Salamat is having a debit balance of 2,300, which represents a negative balance. Loan from Firdaus, 10,000, and drawings. Let's take a look at additional information for the year. Interest at the rate of 10% per annum is payable annually in arrears on the loan from Firdaus. The loan was received on 1st April 2021. So when you take a look at the additional information, you could see that we took a loan of 10,000 from Firdaus. Firdaus is taking interest of 10%, but the loan was received on 1st April, and the financial year ends on 30th September 2020. That means that from April to September, it will be how many months? So April 1, May, June, July, August, September, 6 months. That means that in the calendar year, we utilize the loan for only 6 months. And therefore, when you are charging the loan interest, you have to take into consideration the number of months. B, we have provisions to be made for the depreciation as follows. Freehold property, 5%, fixtures, 10%. They are all on cost. That means that this calls for the preparation of non-current assets schedule. We have electricity charges accrued due at 30th September 2022 amounted to 360. So they were owing electricity charges at the end of the year. And the electricity charges are included in establishment and administrative expenses. Provision is to be made for salary, 10,000, to be credited to Salamat. So Salamat was working in the trading firm, and she was credited with 10,000 Ghana cedis as salary every year. The partners are to be credited with interest on the balances of their capital account at the rate of 5% per annum. Commission on sales owing amounted to 520. So let's take a look at the workings. Well, so the first one, we have the interest on loan. And we all know that with the interest on loan, the loan itself was 10,000. We acquired the loan on 1st April 2021. The financial year ends on 30th September 2021. So between April to September, it means 6 months. So the interest will be the rate of interest multiplied by the principal multiplied by 6/12, which will give us interest of 500. Someone will be asking, why 6/12? It is per annum. So if the interest is per annum and we've used the loan for only 6 months, we can't pay interest on the full year. We're supposed to pay interest for the half year that we used the loan for. That is why it will be the number of months we use the loan divided by the total months the loan was supposed to be used. That is 6/12. The 12 represent the 1 year. The 12 months represent the 1 year, and the 6 represent the 6 months. So the interest on loan will be 500. This interest on loan will be credited to FEDAW's current account because it will increase, or it will be in the benefit of FEDAW's. Then we come to the non-current asset schedule. We have two main assets. We have freehold property and fixtures and fittings. Then according to the additional information we read, we saw that in the account balances, the cost for freehold property was 30,000. Fixtures and fittings was 18,000. Then the next thing you have to do is to determine their total depreciation. The total depreciation will consist of the previous year's depreciation, that is accumulated depreciation, which was given to us in the balances that we saw in the question. So 6,000, 9,600 respectively. Then we come and compute this year or current year's depreciation. In the computation of this year's depreciation, we have to factor in the rate of depreciation, the method, and the cost. In this scenario, we were being asked to use the cost method, and another name for the cost method is the straight line method. So the rate of percentage for freehold property was 5%. 5 divided by 100 times 30,000. This one too, with the fixtures and fittings, it was on cost. So it will be 10 over 100 times the cost, 18,000, which will give a respective current year's depreciation. Then we add the current year depreciation to the accumulated one or the previous year's depreciation. That will give us a total depreciation of 7,500 and 11,400 respectively. When you are done, you take the total depreciation from the total cost of each of the non-current assets. So freehold property will give us a net book value, NBV, of 22,500, whilst the fixtures and fittings will give us 6,600. When we are done, we come to the third additional information whereby we were supposed to compute for electricity owings. So first of all, we have to, since it's owings, we have to add. We are adding because we have consumed the service, and that service relates to that particular year. So whether we are owing or we are not owing, it must be added. So we added a 360 to the balance of the establishment and the administrative expenses because according to the question, they said that electricity charges are included in the establishment and administrative expenses. So that is why we added the owings to the electricity establishment and administrative balance in the trial balance they gave us. Then Salamat is being credited with partner salary of 10,000. Then the next thing that we are going to consider is the interest on capital. According to the additional information, they are saying 5%. So you find 5% on each of their capital balances. Then commission on sales owings. The sales that we made, it is not in this question because this question, they've already given us gross profit. So it's assumed that this commission is an income. So it will be part of our other income. So the owings must be added after the gross profit. Okay. Good. So let's take a look at the main statement. Let's take a look at the main statement here. So income statement. So first of all, you write FEDAW's and Salamat. You look at their income statement and appropriation accounts for the year ended 30th September 2021. The gross profit was being given to us already. We add other income. That is a commission on the sales, 520. Commission on sales that we were owing, 520. This commission on sales is an income. Income owings becomes our current asset. Therefore, when you go to the statement of financial position, you can see that it's there, commission on sales owings, 520. Then we less the establishment and administration expenses, 9,460. This one, it includes the electricity charges owings. Then we come to sales and distribution. Then we come to depreciation. So these are the expenses. We were lucky that this question, most of the expenses were added to get the establishment and administrative expenses. That is why you don't see a lot of expenses here. It's only depreciation. We can have a question whereby the depreciation expense even might be categorized into these two expenses we have here. Then we take our total expenses from the total income. So this 39,520 is our total income. When you take the total expense from the total income, you get the net profit before appropriation. Net profit before appropriation. Then we less interest on capital. When you get the net profit before appropriation, we have to less all the things that will be in favor of the firm, the partnership firm. We have to less all the things that will be in favor of the partners itself, not the firm, sorry. We have to less all the things that will be in favor of the partners and add all the things that will be in favor of the partnership firm, the entity itself. So here, we have some of the appropriation items like interest on capital. This one, it will be in the favor of partners and therefore it must be less. We took loan from Firdaus and Firdaus is taking interest. This one, it will be in favor of a partner, therefore it must be deducted or less. Partner's salary, Salamat too is working. We are paying Salamat. It will be in favor of that partner and therefore it should be deducted. So when you add the three appropriation items, interest on capital, interest on loan, partner's salary, you get a total of 12,500. That will be taken from the net profit before appropriation. Mind you, the drawings we are saying there's no interest charge on the drawings and therefore it will remain at the same stage, no interest. When you get your net profit after appropriation, then you share. We call share of residue. Here, the profit and loss sharing ratio wasn't given, and according to the conditions that must apply in the absence of a partnership deed, it says that profit and loss must be shared equally. So if you have a question whereby they are not saying or they are not telling you to share according to this ratio, divide the residue or the remaining profit into two. So it will be half-half. That's why we got 630, 630. Then we come to the current account of the partners. Here, the left side is the debit side and the right side is the credit side. So as I said, with the current account, the credit side recalls all the positive things or things that will be in the benefit of the partners, and the debit side recalls things that are not in favor or that are not in the benefit of the partners. So they were receiving interest on capital, interest on loan was being received by only Firdaus. That's why I've made it F. Partner's salary, Salamat was receiving salary. Then the share of profit too is their benefit. Then you see here, Salamat was having 2,300 as debit. This means that Salamat has spent more than what she was having in her account. That is why when you check the balances that were being given, Salamat was having a debit balance of current account 2,300, but Firdaus was having 6,000. So when you compare, the last thing was supposed to be drawings. Here, they are not charging any interest on drawings, so just bring only the drawings. If there was supposed to be interest on drawings, the interest on drawings would have been debited to the current account of the partners. They all took something, but there were no interest being charged on the drawings. Then you balance it. We come to our statement of financial position. With the statement of financial position, it is being prepared according to the accounting ratio. That means that total asset must be equal to capital plus liabilities. So their total assets here, if you're able to prepare the non-current assets well, you don't have any issue. You just go and bring their net book values here. So Freehold was having a net book value of 22,500. Fixtures was having a net book value of 6,600. And when you add the two, you get 29,100. After that, we come to the current asset. The current asset we have here is the inventory. And I corrected something on the balances that we have in the question. I said that the inventory you saw to be 2020 is supposed to be 2021. That is closing inventory. Account receivables was being given. Commission on sales owings is income. Income owings becomes your asset, and therefore it will be classified as a current asset. Then we come to the bank balance. You add this and you get this and add to get the total asset. So the 47,920 is the total asset. This is not sole proprietorship. So here it will be financed by their capital account, the current account, plus any other liabilities. Firdaus having a capital balance of this 25,000, Salamat 15,000. When you add it, you get 40,000. But mind you, after the preparation of the partner's current account, they got a debit balance of 73,292. Therefore, they will be negative for them. I said when a partner is having a debit balance, it's negative or is not favorable to them. That's why they are in brackets. So you add the two and you get negative 8,240. which will reduce their capital balance. They've ate more than what they were supposed to eat. So you will get 31,760. Then you come to account payable, that is the current liabilities, the present obligation that they have to transfer economic benefits in the near future. So account payable is 5,800. Electricity owings too becomes a liability. It was added to the establishment and admin expenses, but it becomes a current liability. Then we have the loan principal that we took from FEDAWS. When you add this 3, you get 16,160. When you add to the 31,760, you get a total of 47,920. That means that our statement of financial position has balance. Okay, so 47,920, 47,920. That is all. It's not difficult. Just apply the principles in partnership. If you have any question, feel free to contact me. Thank you very much. Have a wonderful day. Subscribe to the channel and I'll be updating you with a lot of questions and answers.